All right, let's dive into a really fascinating business case study today. It's about a company trying to walk one of the trickiest tightropes imaginable. How do you become a global powerhouse and a local hero at the exact same time? This is the story of Aspen Pharmacare and their incredible Glocal balancing act.
Okay, so to really get what's going on with Aspen, you have to understand this one core concept. They call it the Glocal paradox. Think about it. On one hand, you've got this social mission, providing low-cost essential medicine in Africa. Super important, but not exactly a big moneymaker. On the other hand, you want to play in the big leagues globally? Well, that takes serious cash. And that tension, right there, it's the key to basically every single major decision they've ever made.
And just so we're clear, we're not talking about some small-time operation here. Aspen is a beast. They're the largest pharma company in all of Africa, pulling in around $2.5 billion a year. And with 23 manufacturing sites dotted all over the world, they're an absolutely critical piece of the healthcare puzzle, especially for emerging markets. So yeah, when we talk about this paradox they're trying to solve, the stakes are incredibly high.
So, how do you solve a puzzle like that? Well, Aspen's answer was to make a few massive, really bold, strategic bets. Let's dig into the first one. I love this one. It's what I call the legacy cash cow gambit.
Now, this first move, it sounds completely backwards, doesn't it? I mean, while every other company was pouring billions into finding the next big thing, the next blockbuster drug, Aspen went in the complete opposite direction. They decided to buy up all the old drugs that Big Pharma didn't even want anymore. But here's where it gets absolutely brilliant. You have to look at the logic. Aspen saw a massive opportunity where everyone else just saw, well, leftovers. Big Pharma needed cash for their expensive new research, so they were happy to sell off these aging brands. But here's the kicker. These weren't useless products. They still had steady, predictable demand, and they were often complex to make, which created a nice little barrier to entry for competitors. So for Aspen, it was a total masterstroke. All of a sudden, they have revenue coming in stable, hard currencies like euros and dollars. That was a huge deal because it protected them from the super volatile South African rand and gave them the cash they needed for their mission back home.
And we are not talking about pocket change here. This was a massive bet. They shelled out $1.5 billion to buy these portfolios from giants like GSK and AstraZeneca. A huge gamble. That absolutely paid off.
Okay, so bet number one worked. The cash is flowing in. So what's next? Did they relax? Nope. They double down. This brings us to strategic bet number two, building what you could call a sterile fortress.
This time, instead of just buying up existing products, they decided to invest big time on their own turf. The plan was to build these incredibly complex, world-class manufacturing plants right there in South Africa.
And you got to understand, this wasn't just about pouring concrete and putting up buildings. This was pure strategy. They were building a competitive moat around their business. See, very few companies, especially in emerging markets, have the know-how or the capital to build this kind of high-tech injectable capacity. This single move completely pivoted the company. They went from the crowded, low-margin world of generic pills to the much more valuable world of sterile products. And boom, just like that, Aspen becomes the go-to partner for any multinational that needs to manufacture sophisticated drugs in Africa. And once again, they put their money where their mouth was. We're talking a $550 million investment. This wasn't a short-term fix. It was a huge play to lock down their position for the long haul.
All right, that brings us to their third big bet. And this one might be the smartest and most agile of them all. Let's talk about the smart insulin pivot.
So you remember the pandemic, right? Aspen geared up, built these brand new production lines to make their own COVID-19 vaccine. But the big orders never really came through. So now they're stuck with all this expensive, idle capacity. A potential disaster, right? Well, in an absolutely brilliant move, they pivoted. They turned right around and signed a deal to use those exact same lines to make human insulin. And this move, I mean, it is the perfect example of that Glocal strategy in action. On the global side, they took what could have been a total business failure and turned it into a productive asset, locking in a long-term revenue stream with a global giant. And on the local side, they started directly tackling Africa's massive and growing diabetes crisis. It was the ultimate win-win, proving you can absolutely align social good with good business. And the results were just, wow,
immediate and huge. We're talking 16 million vials of insulin rolling off the line in 2024 alone. And they're on track to help over 4 million patients in Africa by 2026. This isn't just theory. This is strategy having a massive real-world impact.
Okay, so we've seen these three huge, expensive, and risky bets. The big question is obvious. Did it work? Did it all pay off? Well, let's check the scoreboard and look at the strategy by the numbers. And honestly, the numbers really do tell the story. Their global reach, they're in over 50 countries now. That's the payoff from buying those legacy drugs. They're not tied to any one market. That fortress supply chain? Yep, 23 manufacturing sites make that a reality. That's their big infrastructure bet paying off. Their agility? Just look at the 16 million insulin vials, turning a failed project into a home run. And the bottom line? An EBITDA margin hanging around 24%. For a company juggling what they're juggling, that is incredibly strong. It proves they're running a tight ship and actually making this whole Glocal thing work financially.
So it seems like Aspen has pulled it off. They've walked that tightrope, using their global profits to power their local mission. But the game's not over. So the question becomes, what's next? And this is really the central tension now. Is being the go-to manufacturer for huge multinational companies a sustainable long-term plan? Or does it leave Aspen a little too vulnerable? What happens if those big partners decide to change their strategy down the line?
So now, I'm going to turn it over to you. Put yourself in the boardroom. What's the call? Do you double down on this contract manufacturing strategy that's working so well? Or do you pivot again and start investing all that money into developing your own original products? There is no easy answer here, which is exactly what makes Aspen's story such a great case study to think about.